prices being contained in $19.50 to $19.72 range. Overall, we tend to maintain the view that the negative correlation of the USD with gold's price seems to be maintained and may be the main factor behind the movement of gold's price. In this report, we aim to shed light on the catalyst driving gold's price and assess the future outlook. On Wednesday, gold's price tended to gain somewhat, yet the effect of the Fed's interest rate decision remained rather modest. The Fed, as was expected, delivered with 25 basis point rate hike, yet provided little new for market participants. In its accompanying statement, in our opinion, the bank seems to have removed its predisposition for more rate hikes and is now more data dependent. It's as if the bank accepts that it has reached the end of its rate hiking cycle, yet at the same time keeps the door open for another rate hike in the September meeting, if necessary. The release overall was viewed as leaning towards the dovish side and tended to weaken the USD, yet at the same time strengthen gold as mentioned before. Yet the main fluctuation of gold's price in the past week may have been caused by the release of the preliminary US GDP advance rate for Q2. The rate accelerated instead of dropping as expected, highlighting that the resilience and the prospects of the US economy, easing market worries about the outlook of the US economy and enhancing the possibility of a soft landing. At the same time, the weekly initial jobless figure came in lower than expected, implying that the US employment market may not be as loose as expected. Both financial releases, but primarily the former, tended to provide a bullish boost to the greenback and weaken gold's price. On Friday, fresh data showed that inflationary pressures continued to be on the retreat in June. The release of the core PCE price index rate, the Fed's favorite inflationary measure, slowed down beyond market expectation, reaching 4.1% year-on-year, while the headline PCE price index also slowed down, both striking market expectation for the Fed to hold its rate hiking path. As on Wednesday interest rate decision, the Fed stated that the committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectation, and financial and international developments. Hence, the release tended to weaken the USD and at the same time support gold's price. The scenario of the Fed halting its rate hiking path, if combined with the stronger preliminary GDP rate for Q2, enhanced the market expectation that the US economy will be able to avoid a recession. It should be noted that given the above analysis, the acceleration of the GDP advance rate for Q2, and given that market worries for a possible soft landing of the US economy may have been enhanced, yet the yields of US bonds tended to retreat, which more or less tended to enhance the attractiveness of the precious metal. In the coming days, we expect fundamentals to play a key role regarding gold's price, yet at the same time we know that there are key releases that could influence gold's direction. We know today the release of the US ISM manufacturing PMI figure for July. On Thursday, we get the weekly initial jobless claims figure and the factory orders growth rate for June, and we highlight the release of the US employment report for July on Friday. And should the data show that the US employment market remains tight and provide support to the USD, we may see the release weighing on gold and vice versa. Thank you for watching.